Bonds can be less intuitive than other investments such as shares, but they can form an important part of the journey to achieving your goals. So I thought it would be useful to take a minute to provide an update on this topic. Bonds are typically used due to their ability to provide more stable returns and income, as well as the potential to provide protection and diversification in periods of market stress. However, in the shorter term, bonds can deliver negative returns, at times even when share markets are falling. That's what we're seeing at the moment. And it's worth taking the time to understand what's driving these moves and what it means for your clients' portfolios going forward. A yield is the interest rate you receive for holding a bond. Investors will earn income from the bond based on this interest rate. When bond yields rise, the price of the bond falls, and vice versa. Since late 2020, Australian and US 10-year bond yields have risen by over 2%. Because of the way bond prices work, this has resulted in losses of more than 10% for these bonds. The two primary reasons for poor returns in bond markets have been the sharp rise in inflation and strong economic growth as the world recovered from the COVID crash. In response to these developments, central banks around the world have indicated the need to push interest rates higher. At Morningstar, our portfolios have had much smaller allocations to Australian and international bonds in recent years than they normally might, due to the low yields on offer. Instead, the portfolios have held a larger allocation to cash, despite its low return. But unlike bonds, Australian cash has not experienced a negative return. This has served to cushion against the falling bond prices and has also meant that our defensive portfolios have had more funds available for reinvestment in bonds at the current higher yields. Bond markets today are in a much better position to provide two things: a higher income, as well as better portfolio protection in case the economy falters. That's because higher starting bond yields mean they can fall further in this type of scenario, and as a result, provide diversification and protection to the portfolio. For these reasons, we believe bonds can continue to deliver the long-term outcomes we expect from them in a defensive portfolio. History has also shown that after a period of negative returns, like we saw in 1994 and 1999, bond markets have delivered excellent performance in the following years. As always, we're keeping a close eye on developments across markets and constantly thinking about the opportunities through the lens of our long-term, valuation-driven approach.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.